jumping straight into Liebang International today. Everyone is watching the price action, but the real story is their aggressive push into intelligent manufacturing and a surprising new M&A play.
Exactly. You're tuned in to the Easy Money Show, where we make sense of the market's biggest moves. I'm glad you're with us.
And before we get going, please take a second to subscribe and hit the like button. Doing that really helps us continue simplifying the markets for you, bringing you the analysis you need to stay ahead of the curve.
It makes a huge difference.
Yeah, it really does. So let's break that down even further.
Right. So to really understand what's driving the sentiment around this company, we have to analyze their actual operational footprint. I mean, when market observers hear the term commercial kitchens, the immediate assumption is
like a catalog distributor. Right?
exactly, just pushing, stainless steel stoves or walk-in freezers to local restaurants. But Liebang International operates on an entirely different plane.
Totally different.
Yeah, they use an end-to-end service model targeting top-tier institutional clients. We are talking luxury hotel chains, sprawling hospital complexes, public schools, and major government facilities.
So they aren't just dropping off a pallet of fryers at the loading dock and handing over an invoice.
Not at all.
How deep does this integration actually go?
It begins long before the equipment is even manufactured. They manage the initial architectural design of the kitchen footprint.
Oh, wow.
Yeah, they work directly with the facility developers to optimize workflow, spatial efficiency, and safety compliance. Once those blueprints are locked in, they manufacture the stainless steel equipment under their own brand, oversee the complex physical installation, and finally, they handle the ongoing after-sales maintenance.
That initial architectural design phase seems like a brilliant hook to me. By designing the footprint, they're essentially writing themselves into the DNA of the building.
It is a highly effective strategy for creating an operational moat, and it all translates to incredibly high switching costs. When a hospital complex integrates a customized commercial kitchen, they are routing specialized commercial ventilation systems, complex plumbing arrays, bespoke fire suppression networks, all to match that specific hardware.
Which means hospital administrators are, loath to replace that integrated infrastructure just to chase marginal cost savings.
Exactly.
You aren't going to halt operations at a major facility and rip out a custom infrastructure setup simply because a regional competitor offered a slight discount on a replacement oven.
The disruption to operations would cost far more than any savings on the hardware. This dynamic secures highly sticky, project-based revenue.
Very sticky.
And currently, those large-scale institutional projects represent the vast majority of their sales, leaving retail as a very small fraction of their operations. In a sector like China's specialty industrial machinery, which is notoriously fragmented and crowded, by the way, offering an end-to-end value chain insulates them from the race-to-the-bottom pricing wars that plague hardware-only sellers.
Because they're selling a long-term infrastructure partnership.
Exactly.
That leads directly into how they manage the capital generated from those partnerships. The bull case heavily emphasizes their financial discipline, especially following their initial public offering in late October 2024. They priced those shares at $4. How does their post-IPO capital allocation compare to typical industrial microcaps?
The contrast is stark, honestly. The typical playbook for newly public industrial companies often involves immediate financial engineering.
Right, the gimmicks.
Yeah, they take that IPO influx and institute share buybacks to artificially prop up the stock price, or they announce these completely unsustainable dividends to lure in retail interest.
Just to get eyes on the stock.
Right. But Liebang International avoided those gimmicks entirely. The filings show they funneled that capital directly into the physical foundation of the business. We're talking heavy investments in plant construction, equipment upgrades, and research and development.
Building long-term capacity rather than chasing short-term sentiment.
Precisely.
But what stands out to you when looking at their balance sheet while they fund all this expansion? Because that's the kicker here.
It's the complete absence of leverage. According to their filings from late 2024, they are operating with zero disclosed debt.
Zero.
And in a macroeconomic environment where the rising cost of capital has squeezed industrial margins globally, carrying no disclosed debt is a massive competitive advantage. They are not hostage to punitive variable interest rates, nor are they restricted by tight debt covenants.
It gives them immense flexibility to navigate economic downturns. And there is another figure in their filings regarding their operational structure that always catches my attention. They are running this entire operation, servicing these sprawling government and hospital contracts across China with only 141 employees.
Yeah, a workforce of 141 people handling complex multi-million-dollar institutional infrastructure speaks to intense operational leverage. They maintain high fixed assets, but remarkably low variable headcount costs.
Which is a rare combination.
It really is. When you combine that tight headcount with a zero-debt balance sheet and a strategy of aggressive reinvestment, the free cash flow potential becomes highly attractive as the business scales. Every additional project they secure drops much more efficiently to the bottom line because their overhead is so tightly controlled.
Scaling is definitely the focus right now, which brings us to the major catalyst everyone was tracking last month. On February 12, 2026, they officially announced the topping out of their new Phase 2 Intelligent Kitchen Production Facility.
That was a huge milestone.
For a capital-intensive project, finishing that structural framework is a crucial de-risking event. But the key term in that announcement is intelligent. Let's define what intelligent manufacturing actually looks like on the factory floor, rather than just treating it as a corporate buzzword.
Right, because it gets thrown around a lot. In the context of heavy industrial manufacturing, an intelligent facility moves away from traditional manual sheet metal bending and welding.
So no sparks flying everywhere from 50 different guys welding.
Exactly. It involves integrating advanced robotics for custom stainless steel fabrication, automated laser cutting for precision parts, and utilizing AI-driven enterprise resource planning systems to optimize supply chain routing.
So when you are building a bespoke kitchen for a high-end luxury hotel where the measurements have to be flawless down to the millimeter, this technology drastically reduces the margin of human error.
It reduces defect rates, minimizes the waste of expensive raw materials like food-grade stainless steel, and significantly speeds up the production cycle.
Which circles back to the headcount.
Yes, it explains how they can maintain that lean 141 employee headcount. You don't need a sprawling, labor-intensive assembly line if you have an automated intelligent hub doing the heavy lifting. This Phase 2 facility is designed to exponentially increase their production capacity to meet future demand without requiring a proportional explosion in their labor costs.
The Phase 2 facility clearly serves as the engine for their organic growth. But just 2 weeks later, on February 27, 2026, management completely disrupted their own narrative with a highly unexpected M&A play.
Did they ever?
A subsidiary of Li Meng International struck a deal to acquire a 51% controlling stake in a food distributor named Yufengguan.
That announcement is what triggered the highly unusual trading volume and extreme price volatility we saw across the intraday and after-hours sessions. It is a fascinating pivot.
It really is.
Up to this point, they have been a pure infrastructure play. They design the kitchen, build it, and maintain it. Purchasing a controlling stake in Yufengguan pushes them directly into the consumable side of the industry.
Which begs the question, why would a highly efficient, specialized machinery company want to take on the logistical headaches of distributing food?
The strategic synergy becomes compelling when you map it out over a multi-year horizon. By controlling both the physical infrastructure and the daily distribution of the food flowing into that infrastructure, they're constructing a closed-loop ecosystem.
Okay, walk us through that.
Imagine outfitting a major public school district with a state-of-the-art kitchen facility. You now have an established, trusted relationship with that municipality.
You can then leverage that existing relationship to secure the ongoing contract to distribute their daily food supplies.
Precisely. You capture the lucrative one-time project revenue from the physical installation, and then you layer on the recurring daily distribution revenue from Yufengguan.
Transforming the revenue model.
It is an attempt to transform a lumpy, project-based cash flow model into a much smoother, predictable, recurring revenue stream. Markets traditionally assign much higher valuation multiples to companies with reliable, recurring revenue. Looking at the flip side, what are the execution hurdles keeping investors up at night? Because the market reaction to this growth thesis hasn't been purely celebratory, we have to ground this discussion in the hard financial realities.
Right. Let's look at the raw data behind the skepticism. How do the actual revenue numbers hold up to this aggressive expansion narrative?
The historical revenue trend is undeniably the anchor of the bear case here. For fiscal year 2024, Li Bang International reported total revenue of $10.79 million. Now, in isolation, a nearly $11 million year for a company with zero debt and 141 employees shows a functional business. But the market trades on trajectories. That $10.79 million represents a noticeable drop from the $14 million they posted in fiscal 2023.
And an even steeper drop from before that, right?
Yeah, it is a steep contraction from their peak revenue of $15.9 million back in 2021.
That is a clear multi-year downtrend in top-line growth. What is driving that persistent contraction? Is it a loss of market share, or is there a broader structural issue at play?
The contraction is directly tied to the macroeconomic environment in China over the last several years. Li Bang is highly dependent on large-scale institutional contracts. While those contracts are incredibly sticky once they are signed, securing the initial signature requires a healthy capital expenditure environment.
Which has been notably absent.
Exact.
The economic softness and the well-documented cooling of the property sector in China have created a huge ripple effect.
When the broader property sector slows, local government revenues often take a hit, which leads to municipal budget constraints. Upgrading public school kitchen facilities or outfitting new government complexes gets pushed to the next fiscal year.
Makes sense.
Similarly, when consumer spending slows, luxury hotel chains delay their comprehensive remodels. The revenue contraction is less an indictment of Li Bang's operational execution and more a reflection of a cooled-off macro environment dampening institutional demand.
But that cooling demand makes their recent aggressive expansion strategy look quite risky to skeptical investors. And that skepticism was glaringly evident in the immediate market reaction to the Yufengguan acquisition. Despite the long-term, closed-loop synergies we just discussed, shares actually traded lower following the announcement.
The sell-off was driven by a fundamental market truth. Investors despise uncertainty, and the press release was full of it. Management announced the acquisition of a 51% stake. But crucially, the financial terms of the deal were completely undisclosed.
Which instantly triggers a wave of panic for retail investors.
Oh, absolutely.
If you don't know the purchase price, you can't model the impact on the balance sheet.
An undisclosed acquisition price raises immediate fears of potential shareholder dilution. Did they overpay for that 51% stake? Will they need to issue a flurry of new equity at unfavorable valuations to fund the transaction, thereby diluting the value of the stock currently held by everyday investors?
And without those numbers, the market naturally assumed a worst-case scenario.
Always.
Beyond the financial engineering fears, the operational risk seems equally daunting. We just praised their lean operation of 141 employees, but they are simultaneously trying to finish a highly complex, automated manufacturing facility while bolting on a completely different vertical.
It is the textbook definition of execution risk. Food distribution involves its own unique set of logistical hurdles, cold chain supply vulnerabilities, and personnel challenges that are entirely distinct from metal fabrication.
Very different worlds.
Attempting to integrate that vertical right at the finish line of a major infrastructure expansion requires immense management focus.
The bears are essentially asking if management is biting off more than they can chew. If leadership's attention is divided by integration issues with Yufengguan, we could see operational delays at the Phase 2 facility.
Right.
And if the new food distribution wing bleeds cash rather than generating it, that multi-year revenue contraction could easily accelerate.
The sentiment right now is overwhelmingly cautious. The qualitative data indicates that the market acknowledges the capacity expansion and the M&A play as potential long-term positives, but those factors are entirely overshadowed by the lack of clarity on the deal terms.
They need more info.
The market is sitting on its hands, waiting for the company to prove they can execute this dual-pronged expansion without derailing their core business.
Which means for you as an investor or a market observer, the coming weeks and months are going to be vital. Let's lay out the specific timeline and the exact catalyst you need to be tracking to gauge their progress. First and foremost, June 2026 is circled on the calendar.
June 2026 is the undisputed main event for their organic growth story. That is the target date for the new Phase 2 Intelligent Kitchen facility to officially begin operations. Investors need to monitor whether that launch happens on schedule.
It has to be on time.
A smooth operational ramp-up will prove that the IPO capital was deployed effectively, and the new automated capabilities should immediately begin enhancing their production margins.
But there is a crucial financial update coming before we even reach June. You should expect their Q1 fiscal 2026 earnings update to drop around May 2026. That report is going to be the most heavily scrutinized document this company has released since they went public.
The May update should theoretically provide the much-needed clarity the market is starving for regarding the Yufengguan acquisition. Investors will be scouring the footnotes of those filings to find the exact financial terms of that 51% stake.
They'll be looking for the purchase price, the funding mechanism, and any concrete signs of share dilution.
Right. And management will also be forced to provide an update on how the integration is actually progressing on the ground.
The actual execution.
If the filings indicate that the food distribution wing is smoothly integrated and already accretive to earnings, you could see a rapid shift in that currently cautious market sentiment.
But if it's messy,
Conversely, if the numbers reveal a bloated purchase price or operational friction, the bearish thesis will gain significant traction.
beyond the company's specific events, you also need to zoom out and monitor the broader macro environment. Specifically, watch the industrial rotation happening in China and keep a close eye on rate stability.
The macro picture is the rising tide that could lift this specific boat. We noted how economic softness drove their multi-year revenue contraction. Any sustained economic recovery or rate stability in China will disproportionately benefit capital expenditure projects.
Because if the cost of financing major infrastructure upgrades drops, or if local municipal budgets recover, all those delayed projects suddenly become viable again.
Those high-end luxury hotels, expanding school districts, and government facilities that paused their kitchen upgrades in 2023 and 2024 will have the green light to resume spending.
And because Liebang International has spent the downturn building a brand new intelligent factory, they will be perfectly positioned to absorb that pent-up demand the moment the cycle turns.
That's the bull thesis in a nutshell.
Finally, from a pure trading and technical perspective, the momentum and flow from late February cannot be ignored. The stock gapped up and down, appearing on lists of top movers driven by highly unusual trading volume.
When you see volume clustering around an undisclosed M&A announcement to that degree, it indicates heavy speculative positioning. Traders are aggressively trying to price in the risk versus the reward of this vertical integration strategy before the official numbers are released.
So let's buy some chop.
You should anticipate continued volatility as the stock tests various psychological support levels ahead of that official May earnings release.
Okay, that brings us to the lowdown. If you need the lightning-fast summary of everything we've covered, here it is. Liebang International has built a highly defensible end-to-end operational moat in the commercial kitchen sector, servicing top-tier institutional clients. They are currently navigating a multi-year revenue dip driven by a sluggish macro environment, but they are utilizing a pristine zero-debt balance sheet to aggressively expand. They are launching a state-of-the-art intelligent manufacturing facility by June 2026, while simultaneously attempting a high-wire act by acquiring a controlling stake in a food distribution network. It is a bold, high-risk, high-reward strategy aimed at creating a vertically integrated powerhouse right as the Chinese industrial sector looks for a broader rebound.
And that leaves us with one final, brighter crow for you to mull over. When an industrial equipment manufacturer suddenly starts buying up food distributors, it makes you wonder, are we witnessing the beginning of a massive vertical integration trend across China's specialty machinery sector, and who might be the next target?
So great question to keep in mind as we watch this play out. That is all the time we have for today. One last quick reminder to please subscribe to the channel and hit that like button. It makes a huge difference for us. Thank you for spending your time with the Easy Money Show, and we will catch you on the next one.